My name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of LME 3-month nickel and zinc. I'll start with LME 3-month nickel. I am once again still pleased each time I look at this daily chart and find that the same basic drivers are moving the market despite the occasional hiccup. The rock of certainty has been anchored on the same few patterns. They are the middle time, currently 17.095, and upper time, currently 25.90 of the big 2017-2018 shallow bullish shift pitchfork, plus the lower time, currently 17.170, and the middle time, currently 19.480 of the October 2020 to March 2021 bullish shift pitchfork. We also have the slowly rising long moving average below, currently at 17.355. It was also, as I said now some 5 weeks ago, and I quote, "Whilst these two pitchforks are in operation, this market will still have the bullish incentive, even if sometimes it looks like it is missing." End of quote. This had gone a long way to mitigating the strange indecision we've seen in earlier weeks, primarily with contrary key reversals. One final point I'd like to recognise before going further, and one that will be important going forward: the May to date rising wedge pattern, currently 18.120 to 18.990. Now, before I talk more on this rising wedge pattern, I will highlight the key event from 2 weeks ago. We ended up with having a weekly key reversal up. This pushed the market up from not only the congestion between 18,400 and 19,070, dating from August 2014, but also broke the market up and out of the rising wedge pattern 2 Fridays ago. Now, you could think this would carry, well, you would think this would carry the market higher, which it did last week, up over the middle time of the October 2020 to March 2021 bullish shift pitchfork. However, it was at a price. You see, last week we had 2 key reversals down, daily key reversals down, within the same week. Most recently last Friday, and this tempered the move higher. Now, I understand why they happened. It was because of the bearish pressure from the September and June 2014 highs at 19,940 and 19,995 respectively. These are the same two that kept the market back in late February. This now raises a question mark over the possible target's top side for this break upwards out of the rising wedge pattern. An initial target X would be in the 2345 area, whilst the secondary target X1 would be in the 2780 area. Now, I raised this as an issue last week, and I quote, "The immediate issue with these is the same as why today we've turned down and likely did so back in late February, at least to some degree. We have the significant September 2014 and June 2014 highs at 19,940 and 19,995. Remember those numbers in the way first. This is a pair of big obstacles to overcome, so it's no surprise to see a reversion back down today as prices edge closer to them. The question now is whether the bullish rising wedge pattern is enough to take us higher, or is this move up late last week and early this week still a false break?" End of quote, again from last week. Well, we can see that it is not a false break upwards, as it has been turned down by what seems to be a stronger force right now. Now, there's plenty of ammunition below. The question though is it enough? LME 3-month zinc. On the surface, this metal looked and looks like a gently rising market over the last few weeks, with the most notable feature being a weekly key reversal up 3 weeks ago. Not so. I've said this already before, there are some significant forces at play here, and all is not what it looks. So let's take a look back and see how we've gotten here and why I think there are strong undercurrents. As I mentioned back when I had made written commentaries back in November last year, was that the 50% Fibonacci line of the 2006-2008 move at 2806 is key. 2806 is key. The weekly key reversal down 6 weeks ago just proved that again recently, as the Monday following, that is 6 weeks ago, prices bottomed out at the 2806 area. Since then, we've seen prices move up along the May 2020 to date, broken but still potent uptrend. Currently that's at 3012. Now, I posed a question some 6 weeks ago related to this move down and lack of follow through lower. Basically, what's next? Well, the action since the big fall in March looks suspiciously like a bearish bump and run reversal top. It is not perfect, as the trend line for such a move would be down at 27.81, a little below the slowly rising long moving average. However, it was not unusual for such a pattern to see some hesitation around this trend line area, before seeing a strike for lower levels. The only issue is that this recovery has gone on too long, in which case I put forward then the idea for another pattern type, a possible bear flag or bearish measured move lower. What was most interesting about the whole affair was how prices had followed the broken but still seemingly valid May 2020 to date uptrend. Indeed, this uptrend is key to what has been going on in recent days. The move up has been fraught with indecision. 3 weeks ago we ended up with a countering move to the 6th level. Yes, 6 levels. I know incredibly indecisive it is, but yet still the market rose higher, sticking all the time to this broken rising uptrend. This made my comment 2 weeks ago that such action is not incidental. I clarified my thoughts thus, and I quote, "It seems to me that the market is currently trying to navigate up this uptrend, but it has at the steering wheel someone seemingly heavily inebriated, overcompensating on each day, as prices generally move in the direction that is wanted. This is not safe, nor can it last. I would urge caution when the drunken driver of this market either stops or gets pulled over." End of quote. That was 2 weeks ago. I added one final thing 2 weeks ago. I had still left targets X1 and X2 on the daily chart. These were and still are, I suppose, the initial and full targets for the diamond continuation pattern formed over January to March this year. The market has already previously reached target X1 in the 30.95 area, and I'd previously expressed doubts about the market having impetus to reach target X2 in the 32.15 area. And I was about to retire these two, but I kept them on just in case. 2 weeks ago, and then again last week, it was a maybe, just maybe, type comment from me on this idea, but it seems to be gaining credence in my eyes that the diamond pattern from much earlier this year, that's looking back, well, really from the end of 2020 up until March 2021, is indeed the driver for the recent moves higher, and perhaps all other patterns since are subservient to that core pattern, moving the market higher. I want to think about this a bit more, as I think it may be the reason why we haven't triggered a bearish bump and run reversal pattern or a bear flag pattern even. Just be careful. I don't like drunken drivers or drunken markets either. Now I'd add one final comment for this current week. We have made a recent high and come off. The move down has been quite large, from a height of 30.59 down to 29.60 today. It wouldn't need much, only a move of $16 down this week from the low to 29.44 from 29.60 to set up a possible weekly key reversal for this week. This is something to pay close attention to, as we still have 3 more days of this week left to go. We've only just done it over 2 days, so what can the next 3 days bring? Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright Eddie Tofpik and ADM Investor Service International Limited. And here comes the final bit.